The stock market is often described as a complex and unpredictable entity, a dynamic system where countless factors interact to influence the prices of financial assets. While some investors and analysts dedicate their careers to forecasting market movements, the inherent unpredictability of the stock market remains one of its defining features. This unpredictability stems from a mix of economic, psychological, geopolitical, and technological factors, each of which contributes to a constantly shifting landscape. The complexity of market dynamics. The stock market operates as a mechanism where supply and demand dictate the prices of stocks. However, these forces are influenced by a plethora of variables, including corporate earnings, economic data, interest rates, and investor sentiment. The interplay between these variables creates a system so complex that even small changes can lead to disproportionate effects, a concept often described as the butterfly effect in financial markets. For example, a single unexpected interest rate hike by a central bank can ripple through global markets, affecting everything from stock valuations to currency exchange rates. Adding to the complexity is the role of macroeconomic indicators such as inflation, unemployment rates, and GDP growth. While these indicators provide clues about the health of an economy, their interpretation and impact on markets can vary widely. A robust GDP growth report might signal economic strength and drive stocks higher, but it could also raise fears of inflation and prompt a sell-off. This ambiguity underscores the challenge of predicting market behavior based on economic data alone. The influence of human behavior. Human psychology plays a crucial role in the stock market's unpredictability. Investor sentiment, driven by fear and greed, often leads to irrational behaviors that defy logic and economic fundamentals. For instance, during market bubbles, excessive optimism can push stock prices far beyond their intrinsic values. Conversely, during market crashes, widespread panic can lead to a sell-off, even in fundamentally strong assets. Behavioral finance studies have shown that cognitive biases like overconfidence, herd behavior, and loss aversion significantly influence investment decisions. These biases create feedback loops that amplify market volatility. For example, during a market downturn, fear of further losses can lead to panic selling, which in turn drives prices lower, creating more fear and perpetuating the cycle. Geopolitical and external shocks. Geopolitical events add another layer of unpredictability to the stock market. Wars, trade disputes, political instability, and unexpected policy changes can trigger sudden and significant market reactions. For example, the onset of the COVID-19 pandemic in early 2020 led to one of the fastest market crashes in history, followed by an equally rapid recovery fueled by unprecedented fiscal and monetary stimulus. Similarly, natural disasters, technological disruptions, and cyber attacks can have unforeseen consequences for financial markets. The interconnectedness of global economies means that an event in one part of the world can have cascading effects elsewhere. A disruption in the oil supply chain due to geopolitical tensions in the Middle East, for example, can drive up energy prices and affect industries worldwide, influencing stock prices in seemingly unrelated sectors. The role of technology and algorithms. In recent decades, the rise of technology and algorithmic trading has added another dimension to market unpredictability. High-frequency trading, HFT firms, use complex algorithms to execute trades at lightning speed, often exploiting minute price discrepancies. While this increases market liquidity, it also amplifies volatility during periods of stress. Flash crashes, where markets plunge and recover within minutes, are a direct consequence of algorithmic trading. Moreover, the proliferation of social media and online trading platforms has democratized market participation, allowing retail investors to influence stock prices in unprecedented ways. The meme stock phenomenon of 2021, where stocks like GameStop and AMC saw dramatic price swings fueled by coordinated buying on platforms like Reddit, exemplifies the power of collective retail investor action in shaping market dynamics. The limitations of prediction models. Despite advances in data analysis and predictive modeling, accurately forecasting stock market movements remains a formidable challenge. Quantitative models often rely on historical data to predict future trends, but past performance is not always indicative of future results. Markets are influenced by unforeseen events, and models cannot account for every possible variable. Even sophisticated models that incorporate machine learning and artificial intelligence face limitations. These models may identify patterns and correlations in data, but they cannot fully understand the context or anticipate human reactions to unexpected events. Moreover, the widespread use of similar models can create systemic risks as their predictions and actions may converge, exacerbating market swings. The Efficient Market Hypothesis, EMH. The efficient market hypothesis posits that stock prices fully reflect all available information, making it impossible to consistently achieve above-average returns through market timing or stock picking. While this theory suggests that markets are rational and efficient, critics argue that it underestimates the role of irrational behavior and unforeseen events in shaping market outcomes. The debate over EMH highlights the difficulty of reconciling theoretical frameworks with real-world market behavior. Strategies for navigating uncertainty. Given the unpredictability of the stock market, investors often adopt strategies to mitigate risks. Diversification, or spreading investments across different asset classes and sectors, is a common approach to reduce exposure to any single market event. Long-term investing, focusing on the underlying fundamentals of companies rather than short-term price movements, is another strategy to navigate uncertainty. Some investors turn to technical analysis, which examines historical price charts and trading volumes to identify patterns. Others rely on fundamental analysis, assessing a company's financial health and growth prospects. While these methods provide valuable insights, neither can guarantee success in an unpredictable market. The role of luck and timing. Finally, it is essential to acknowledge the role of luck and timing in stock market success. Even the most informed and strategic investors can fall victim to bad timing or unforeseen events. Conversely, some individuals achieve significant gains purely by being in the right place at the right time. This element of chance reinforces the notion that the stock market is not entirely predictable. Conclusion. The stock market's unpredictability is both a challenge and an opportunity. While it can lead to significant losses, it also creates the potential for substantial gains. Understanding the factors that contribute to this unpredictability, from economic variables and human behavior to technological advancements and geopolitical events, can help investors make more informed decisions. However, even with the best tools and strategies, the inherent uncertainty of the market underscores the need for caution, adaptability, and a long-term perspective. Ultimately,